Hi everyone, in this video we are going to talk about how to start a beginner using spot trading. What is spot trading? Basically, it is the purchase and storage of cryptocurrency, which is what crypto exchanges were originally created for. Crypto exchanges. Not all of them, for example. It was ByBit that was originally a futures exchange, but then spot trading was added to it. So, we have registered on ByBit, and the first thing you need to do already after you have been verified is to deposit your balance. You can do this in 3 ways. It is with cryptocurrency, if you have it on another exchange or on some wallet, for example, MetaMask. How do you do it? We click Buy Crypto, select Crypto Deposit. Here we'll just need to choose the network we're going to use to deposit. Most often it is USDT, as you can guess. Yes, so click on USDT. Choose which blockchain we want to use. Most often it's ERC20 or BEP20, so either Tron, their network, or the Binance network. Let's say we choose BEP20, and this is where we get our address. We take it, go to MetaMask or some other wallet, and simply transfer your cryptocurrency to this address. The second way is to deposit directly from the card. That is, we choose fiat deposit, and it should be noted that now only advanced cash is available here. Not many people use it, as far as I know, so this method is very niche. It is simple. If you have advanced cash, just withdraw the amount. Immediately you will be thrown to the site Advanced Cash. You will link your account, wallet, and can immediately replenish the account. If you want to deposit from your card, we are interested in the third way. It is peer-to-peer. Peer-to-peer is a 2-level trading. That is, you transfer money from your card to his card, for example, from PayPal account or something else. He in turn transfers you cryptocurrency from his account to your account. Here you go in, choose the currency you need, choose the desired method for payment. For example, click Buy USD. And here in this way, for example, through the Vice, let's say $10. So you transfer $10 from your Vice account to his Vice account, and you get USD. You have entered, clicked Buy, get the details and transfer. Everything is ready. The exchange very responsibly monitors everything, so that there were no deceptions. If suddenly there are any disputes, the money did not arrive. Something else. You open an appeal, and very quickly the exchange will sort everything out. And I have been trading for almost 6 years on ByBit, and not once have I had to use it, because people always did everything in time. After you have funded your account, you need to go directly into the continuous trading. To do this, click Trade by Trading. Here we will talk a little bit about the interface. In the center you see charts. Charts can be filtered by different time frames, by 15 minutes, by weeks, and so on, for convenience. On the left we see the cryptocurrencies that we need, just above their data about them. That is, what currency pair we have, the current price, the change in a day, the highest value, the lowest value, and so on. What do we need to do to buy cryptocurrency? Let's say we have USDT. We want to buy 1 Bitcoin. There are 3 ways to buy Bitcoin. Not 3 ways, but 3 types of orders. The first order, it's a limit order. Here they are by default. Here we have limit, market, and take profit stop loss. A limit order, what is that? You create a position as a maker. What does that mean? You want to buy 1 Bitcoin, for example. You enter 1 Bitcoin, you enter a value. Bitcoin. Enter the value at which you want to buy it. Let's say we want to buy it at $43,000. The value right now is $43,469. Click on Buy Bitcoin. What happens is you add your buy trade to the trades right here in the orders, and when the price drops to that value, all the people who want it, they sell you a volume of 1 Bitcoin at that price. It can happen as 1 person from 1 sum. Another trader, or a lot of them, 1 Bitcoin is a pretty big volume. It's probably going to be like a lot of traders. They'll sell it to you and you'll get your Bitcoin. There is less commission on these trades because you are creating a market, adding a trade to it, not taking it from there. If you want to maximize your profit on something, use a limit order. If, however, you want to make a trade instantly, or you have a small amount of money in there, because if you trade on 1 Bitcoin, it is better to create a limit, so that it is gradually made. Why, I explain, because if you buy $40,000 on the market, let's say, $40,000. Of currency? What happens is, first you will have transactions for this amount at the current price, 40,386. When people who are ready to sell at this price will run out, well, their volume of funds, he will buy more expensive, more expensive, more expensive, more expensive. Everything is less profitable for you in the price. Plus, there will be a commission on top, because it will be a commission taker. Because you take away, close some positions. The exchange is less profitable than to give away. You click buy Bitcoin, that's it. You buy Bitcoin, you have Bitcoin on your balance, you hold it, you store it. Then we have the third type of holdout, which is take profit stop loss. What is that? It allows you to set a trigger price, and at this trigger price to create either a limit order or a market order, i.e. the two previous ones. What is it and what is it for? And what it's for. It is often used to lock in your profit. Basically, take profit stop loss means to take your earnings or stop losses. That is, for example, you bought Bitcoin for $40,000, it is now $43,000 and you want to sell it, but not right now, but in case the price starts to fall, that is, let's say, you want to stay in the plus. So you put a trigger price of $42,000 and put, let's say, a market order on the market. What's going to happen? When the price of the cryptocurrency reaches that value, he will sell it on the market and lock in your profit. Or the other way around, you think that if the price hits, say, $45,000, then everything will go even higher and you just want to buy at that moment, let's say, or buy a little bit lower. That is, you calculate, look at the charts well, you are an experienced trader. Yes, you analyze the charts, see what's what, look at resistance levels, other indicators, but this is for general information, most likely, I'm telling you, because this video is still for beginners. In general, what is the point? Let's say you think, if it breaks through $45,000, there will be a small correction, it will go, let's say, up to $43,500, and then go further. So, the price breaks through $45,000, you have your limit order at $43,500. When the price falls to these values, you buy the cryptocurrency, and you have it on your balance. That is, you enter the trader's price. Enter an order, choose whether it is market or limit, enter the amount, let's say the same one Bitcoin, then click buy Bitcoin, that's it, it's bought. After that, after it's bought, you have exactly the same options, exactly the same three types of orders. I think there's no point in dwelling on them because everything is the same. On the limit, you enter the price of the quantity, click sell Bitcoin, you have a sell order, it's executed when people buy it, respectively. On the market, everything is the same, only it happens instantly and take profit stop loss is used in the same way. The only point that is still there is margin trading. What is it? It will allow you to earn on the fall of Bitcoin price, not only on the growth, if you trade short and accordingly increase both your income, if you competently trade and guide. Guessing the direction? Yes, but not guessing, but guessing. If you're just playing guesswork, you shouldn't get involved in this, because the risks are very high. Here you are leveraging, let's say, if you buy one Bitcoin, yes, in Plonk you buy one Bitcoin, well, just the most common purchase. With leverage of 3, it is as if you will own 3 Bitcoins. So the amount increases here, and the situation will be that you will have to give these 2 Bitcoins on top of the exchange. If you sell them in the plus, everything will be favorable. Yes, that is, sell exactly the same as you bought and sell. And it is done from the usual spot section then. That is, you just have Bitcoin not 1, but 3. Here is a sell, when you can sell, yes, let's say, on the market. Sell 3 Bitcoins. The trade will automatically close. You'll come out there in plus 3 times more than you would have come out in plus without margin trading. But if you're wrong, if for example the price is going to fall, yes, you were wrong in your judgment. And then if the price falls, but for you to lose everything, yes, in Bitcoin already in spot ordinary, then the price has to fall 100%. When Bitcoin is worth 0, you've lost everything you had. But for example, with a credit of 3, it should only drop 33%, and thus your transaction, that is 100 at 33%. 33, 3, 3, 3, 3, 3, 3, 3. So the trade will close just so you pay back the stock exchange. That's how it works. I don't recommend you use margin trading while you're a beginner. Let's just focus on a regular spot. Here, the risks of losing everything are literally minimal. They are basically non-existent, unless you are trading some obscure altcoins that just came out, which are just scammy. If you are buying Ethereum Bitcoin, there is no risk. That's pretty much it. This is the very base, the very foundation of spot trading. I hope it was clear for you. If not, ask your questions in the comments. I'll be sure to answer them. See you in the new video. Bye, everybody.